Morning, everyone, and thank you very much for joining me this morning. And just before we get started, can I just get a sound check? Of the opinion that should be okay now. Yeah, okay, awesome. Thanks, Zanetta. All right, and good morning to you. Thank you, everyone, for joining this morning. And next week, Friday, is non-farm payrolls. I've set up the link, so I'm just going to put that into the. I'm going to put that into the chat. It's not going to be emailed out this month, just the email marketing guys. I've got a full schedule. So if you need to get the link for the live trade, just email me on rshore@fxcm.com. Otherwise, I'll be putting the link in the chats throughout of next week. Welcome to the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. As mentioned before, my email address rshore@fxcm.com, and today is Friday, it's the 27th of May 2022. I'm just going to bring up a high risk investment warning. I'll keep this on screen for a few moments, and then I'll bring up the commentaries disclaimer. Hey Anna, good morning to you. Thank you for joining. Hey Rob, nice to have you on the webinar. Thank you everyone for joining this morning. As always, it is highly appreciated. Going to bring up our market commentaries disclaimer now, and keep this on screen also for a few moments. I was also thinking we've got to try work in a scalp, which we used to do when we used to hold the US Open, which we're not holding anymore. But I'm kind of the opinion, we've got to carry on doing that every once in a while, because even myself, it's like I'm losing the methodology, and I thought we were onto a really good thing there. So I'm going to try to schedule something for that. I know also Anna asked for a webinar in terms of fundamentals. I'm wondering if we can kind of maybe put those two things together. Let me give that some thought. References, FXCM Market Scope 2.0. We're going to take a look at Cnbc.com, the morning note. Just we must know what's going on with the headlines. Obviously, 2022 is in a very, very news-driven year. I guess every year is driven by news, but this year we've had some serious disruptions. So we want to just carry on looking at the morning note and seeing what we're in for the day, and then we may we are going to look at tradingview.com. I want to just consider the US 10-year again. So that's what we'll do. Yeah, Rob. So we kind of developed a scalping methodology during the US Open over the course of a few months, and we actually got something really workable going. We just, I don't want to neglect that. So we just need to revisit that. Definitely worth giving it some thought when we can schedule that in. All right, let's go through to the morning news, and then afterwards, I think we should spend some time on the 10-year, and then try and see if there's any opportunities in the market, because yesterday it was heavy in terms of the economics. Let's see if there's any opportunities for us as traders. All right, so the CNBC European report has the following headline: European stocks set for tepid open, but on course for a winning week. And it reads as follows: European stocks are set for a muted open on Friday, but are heading for a positive week, joining global counterparts as fears over a tightening of monetary policy subside. I've got some thoughts about that. I think that the fears subsiding is really, my opinion. We know that markets ebb and flow. We know that there's the impulse correction. I just think the markets are due for their corrections. The news wires need to write something with regards to why there is some sort of correction. And a good story for this is, well, monetary policy is not going to be as tight as initially feared. I'm not so sure that's the case. We're dealing, interest rate hikes aside, okay, the big unknown, and it may turn out to be much less, acute than I think, but the quantitative tightening is going to be a disruption. I don't see it any other way. It's just basic demand versus supply, economics 101. You're basically siphoning supply out of the economy. Now, we're not just talking about siphoning supply out of the economy. We're talking about siphoning liquidity out of a global economy that is addicted to liquidity, right? I don't think that we should ignore that fact. My personal feeling is there's going to be lots of disruption there. So just keep that in mind. All right, the article continues as follows. Markets in Europe Markets in Europe closed higher on Thursday, receiving a boost after British Finance Minister Rishi Sunak announced a range of measures to tackle the country's cost of living crisis, including a so-called windfall tax on the profits of oil and gas giants. Thursday also marked the end of the World Economic Forum, where the world's leading financiers, politicians, and business gathered in Davos, Switzerland, to discuss the issues the global economy faces. Some bleak predictions were offered, particularly for Europe, which many economists see as vulnerable to a recession. US stock futures were slightly lower in early pre-market trade on Friday after a strong previous session on Wall Street set the S&P 500 on course to snap a 7-week losing streak. Shares in Asia Pacific advanced in Friday's trade, with Hong Kong's Hang Seng Index jumping by around 3%. Tech giant Alibaba soared after the country reported stronger than expected fourth quarter earnings. I beg your pardon, after the company reported stronger than expected fourth quarter earnings. Markets also remained attuned to the conflict in Ukraine, with a US official saying Russia is making incremental progress in the Donbass region. Russia's defense ministry claimed overnight that it would allow foreign ships to leave ports on the Black Sea and Sea of Azov, according to state news agencies Interfax, amid mounting concern about rising global food prices. On the data front, final French quarter GDP figures are due to be published, along with Spanish retail numbers for April. All right. So I think I want to take a look at the US 10-year, but just something in that article which I think is worth keeping an eye on is, of course, wheat prices. So Russia saying it's opening some ports to get food out, and I just want to see what the wheat prices are doing in response to that. All right, here it is. Okay, so let's just take a look at on a weekly scale. To me, it's still very worrying. The wheat prices here are one of the sort of proxy instruments that I'm looking at, just in terms of supply shocks, including food prices, okay, which particularly for emerging countries is going to be, it's going to be a real crisis if we have these shortages. And well, yes, the ports have opened. Prices haven't really reacted as much as we need them to react. We really need these to come down, but it's not doing that. And we just want to keep an eye on this, because again, I think this is one of the variables, one of the dynamics that is, which is an important variable to watch right now, because it's contributing to stagflation, which is the story, right? So let's just put in our peaks and troughs, and you can see that there is a trough over here. And once we've got the references in, you'll see that we're not out of the woods here by any means. Okay, so we've got here's the trough, here's the peak. I think that we can put in a higher trough over here, and I think this is a higher peak. Now, what we really want to happen over here, just in terms of general global welfare, okay, is we kind of need this to do this. Okay, which is a big ask, because I'm not sure that the opening of the ports are really moving prices. The fact is that the supply shock is still very much a part of the trend, peak and trough, right? Now, yesterday, oil started moving. Oil started moving yesterday. So if we just go through to US oil here, right, you can see now, again, we look at the weekly chart, and I sort of lump this in the same category to wheat prices. They're going to hurt the emerging economies the most, but everyone's going to feel it, you know. So the crisis is going to be acute in the emerging economies, but it's going to be felt globally. So you've got your trough, your peak, okay. You work your higher trough here, and you've got your higher peak here. You see, now what we need effectively is for prices to move like that. Just to come down, we're at 113 bucks. Remember earlier in the week we were talking, earlier in the week we put a measured move, we got $200, which is really high, but I mean 150 I think is sort of achievable. It really depends on momentum, but that momentum is it's turning, it's heading back into that 80. Remember, this is primary trend stuff. It doesn't matter about the but it does matter. The intraday movements clearly matter for us as traders, but in terms of macroeconomics, it's the primary trends that are really going to do the damage. Okay, let's just take a look here. Why did you not include the big candle in the wheat? All right, so I've got two comments here. So Anna's asked a really good question. Why have I not included the big candle in wheat? And Russ, a big one, and Rob saying, I don't understand the logic with wheat dropping. And you say you don't understand, Rob. Just explain why do we need the price of wheat dropping? Is that the question there? Is that the question there? Okay, all right. So the price of wheat here, Rob, is what I'm effectively using it for. I'm using it as a proxy for just general supply shock analysis, because it's obviously a very accessible instrument. And I'm going to come to your question, I promise you, in a moment, and then we'll look at your tenure. Then we're going to look at actual opportunity. So the way I think I should explain this, Rob, is using a demand supply chart. So let me just bring up my Microsoft Paint. So let's just understand the pressure that we're facing globally. Okay, it comes down to this word. It comes down to this word, stagflation. Okay, this is really bad news. Okay, it's bad news because there's no real policy prescription, and the the way that I am looking at it, which I believe is the correct way, is via supply shock or supply shocks. Okay, and in order to look at it in supply shocks, I'm generally just looking at two instruments, oil and wheat. We can look at corn as well. We can look at a whole host of supply side raw materials effectively that and then come up with some sort of conclusion. But I think that just looking at oil and wheat does a fair job over here. And what we're looking at, Rob, is on an aggregate level. Okay, so we're looking at this on a macro level, not a micro level. In other words, the demand curve here is aggregate demand, and the supply curve here would be aggregate supply. And just the y-axis, let's just call that inflation. Y-axis is generally prices. Okay, we're just going to call it inflation. And the x-axis is usually GDP. We're going to call it unemployment because I think we can all relate to these variables. And we looked at unemployment in really good sort of detail, I think, yesterday. Now, just normal economics says, well, when your demand intersects your supply, that's your equilibrium, and that's sort of where we want to be. But we have to add one more part to this, and that is what we call potential, or in this case, Rob, I'm going to call it full employment. Okay, so I'm going to say, well, let's say that this level here is full employment. Let's just call it YF. Okay, we'll call that YF. That's full employment. Now, full employment doesn't mean everybody's got a job. That's not what it means. Full employment means that there is, of course, a natural rate of unemployment. There's always going to be a natural rate of unemployment, but that's factored in to full employment. And then we've also got, we'll call this, let's call it I star, okay, the equilibrium inflation rate. And if we are at full employment, one more thing to do here. We pretty much at a red, this is kind of Goldilocks stuff, you know. This is kind of, there's no real reason that we need to move off of this. Now, look what happens here. Okay, the fact of the matter is, COVID threw us off of full employment. Okay, COVID threw us off of full employment. COVID threw us off of full employment, and then through combined monetary policy, when I say combined monetary policy, interest rates went basically down to zero, pretty close to zero, combined with a huge expansion in fiscal policy. We actually got demand shifting here. Got demand shifting here, and we had to do that because we wanted to get back to full employment. But it came at a cost. It came at a cost. What was the cost? The y-axis was the cost. Sure, we got back to full employment on the x-axis. Now we way off our star, right? We're now at high inflation, right? We'll just call this RH. And the idea is now the Fed's kind of trying to figure out how it can control the high inflation. Well, all of a sudden we get these supply shocks. What are the supply shocks? This is because of the war in Ukraine. I'll make this blue, where oil channels get disrupted. Not only oil channels, Russia and Ukraine are huge exporters of wheat, corn. That gets shot to the point. Last I read, I'm sure it's higher now. 400,000 tons of wheat had been stolen by the Russians, and it's basically been embargoed. And nobody's going to take on stolen wheat, right? So now, what's happened here is we're moving off of full employment again, and we're getting even higher inflation. So now we've got to factor in the what the Fed's going to do here. Well, the Fed's actually going to raise rates. So what is that going to do? Well, it's going to potentially, let's make this, it's going to potentially cause recession. When we call recession, when we talk about recession, look what's happening to unemployment. Sorry, this would be employment. So your employment is declining. Now, the bulk of the price increase over here, okay, the bulk of the price increase here and the supply, it gets felt on the emerging market side because they're more sensitive to it. They are the huge importers of Ukrainian wheat, Russian wheat. So if we carry on getting the price moving up here, Rob, of course, the emerging markets, which rely so much on the imports for just basic food, they get hit the hardest. Does that answer the question? I hope I've answered the question and not done it in a sort of a circular manner. Does that help at all? If it doesn't, let me know. Anna's just saying the grain shortages are going to get worse. Okay, Anna saying that, all right, so in her inbox, Bloomberg has an article written by Andy Mukherjee saying India shouldn't have promised to help feed the world. Now the scorching heat wave has hurt its wheat crop. Yeah, so what's happened there, Anna, is that, well, they are clamping down on their exports because they need their wheat internally, right? So that's another supply shock happening right there. Then, of course, exacerbated by the Chinese lockdowns as well, adds to all of these supply shocks. Now, that's why we've got the higher trough, higher peak. Now, what happens if we get the next higher trough here, and then the next higher peak there? Then prices continue, then stagflation continues. That's kind of where we are. Let me know if that's unclear. Have I explained that okay? Okay, cool. All right. Rob's having a think about that. Just want to come back to this. Why haven't we used? So Anna's asking, well, why haven't we used this this over here? We can use it, but at the end of the day, and it's not going to make a difference to the analysis. Okay. What it does do is it kind of puts a resistance here, but let's put the peak. Let's put the peak here and see if it changes the analysis. So let's put the peak here. Let's put the trough here. Then we've got this actually then becomes what we call a lower peak, right? Becomes a lower peak. And then, well, what's the next point after that, Anna? Well, the next point after that's the higher trough. And what's the next point after the higher trough? Well, it's a higher peak. So even if you're using this as a reference, you're still going to get the same conclusion, that we've got a higher trough followed by a higher peak. This, you see, this is the key. This is the I'm trying to get a record. This is the price action that counts, because this is the price action that's affecting us. So yeah, we had a spark up here. There's no doubt about it. But it kind of doesn't influence trend right now. It's because even if we add it in, we've still got the higher trough, higher peak. Does that answer your question there, Anna? So we get this, even if we put the peak there, we come to the same conclusion. All right. In all of this, again, we are going to come to, I'm going to come to chart analysis in a moment. I'm begging your pardon. I just want to do this kind of grew out of the conversation, out of the fact that the Russians have opened up the port. Again, I'd like to see this come down, because what that effectively is telling us, maybe this is something else that will help the discussion, Rob, is that we're increasing supply. Once you increase supply, take a look at your aggregate supply. It comes back in, doesn't it? Comes back in. Ultimately, if it can move back to this point, you know, that would be best. But increasing supply takes off some of that stagflationary pressure. That's effectively what we're looking to happen. Okay, but price is not reacting. That's the concern. Price is not reacting there. All right, let's just take a look at the. Let's take a look at this guy here. Again, I'm of the opinion that this is an important chart. This is pulling back. When I say this, what are we looking at? We're looking at interest rates. Okay? We're looking at the US 10-year yield. Why is it such an important chart to look at? Because I think there is a strong correlation between the US 10-year and the dollar. And what we can do to test if that's true is that we can put in just a dollar chart underneath that. All right, and you can see, let's just talk about it on an absolute basis. Okay, kind of, sort of, just on an absolute basis, sort of cutting out the middle. So just, I know I'm taking sort of a big sort of liberty here, but the idea is you can see that there's at least a positive movement on an absolute basis. Where it gets really interesting, of course, is at this point when the dollar bottoms. That's really where it gets interesting. And again, on an absolute basis, we can just connect it. Okay, so this is where the correlation becomes really apparent. From about when the dollar bottoms, and the dollar is supported by tighter monetary policy. Tighter monetary policy is reflected in US 10-year. What's happening here is that the yield has dropped from 3.2% to about 2.75%, so it's lost 25 basis points, and the sort of interpretation of that would be that, well, perhaps the US Fed cannot be as aggressive. Perhaps the US Fed cannot be as aggressive as we initially thought. And then the Fed minutes came out and seemed to give the market some sort of reason to believe that, saying, but the only thing the Fed said is that they are going 50 basis points in the next two, and then they're going to reassess. You can see that the dollars pulled back in tandem with the US 10-year. So the question here is what's happening with the 10-year? Because what's happening with the 10-year is going to affect the dollar. What happens with the dollar is going to affect everything else. So this is a good place to start. And what we should do here, I think, is do a top-down analysis on the US 10-year, and what we can do here is we'll just put in the RSI. And what we want to see here on the RSI is that the 10-year was overcooked, okay, and this normalization of it, whilst it seems to be being celebrated that the Fed might not be as aggressive, what I'm worried about is that it's just a normal correction in the market. In other words, bond action, whatever's happening on the bond side. In this case, it would be the purchasing of bonds, okay, and the purchasing of bonds push the price of bonds up, yields would go down, and that's why we're getting this kind of movement down here. Well, that could just be sort of normal profit taking by the shorts. It could be long positions being entered into as money rotates out of risk markets. It could, for a whole myriad of things. We know that market participant action is going to it's going to cause the ebbs and flows. And you know, we've got this normalization here. Now let's go back. Okay, let's say that the Fed is going to be, less aggressive than initially thought. Let's just say that is correct. Fine. Does that cap interest rates? Well, again, let's go back just to a basic supply versus demand. Okay, and I'm of the opinion that the law of some supply and demand is really kind of extremely powerful in this type of analysis. So we kind of go back here. Let's get rid of this, and let's just do a very sensical. Let's have a very sensical approach to this. Let's call the y-axis. Remember, we said it's prices. So instead of looking at it in terms of inflation, now we're going to look at it in terms of the price of money. What's the price of money? It's interest. Yeah, so it's the interest. We've got the price of money, and what we're going to look at on the x-axis here is actually, the supply of money. Okay, we're going to look at it in terms of the supply of money. And at any time any one time in the market, there's a fixed supply of money. Right now, as you know, us talking, there's different definitions, but by and large, there's a fixed amount of money in the economy. And based on that supply, there's also a downwards demand curve. Just want to explain the gradients here, because they're slightly different to the aggregate demand, aggregate supply. There is a fixed amount of money, so the money of supply can't have a slope to it, because right now, as we're speaking, there's X amount of money, right? So that has to be vertical. Why is there a downward supply of money? Well, just think about it in terms of your credit card. Okay, the cheaper the interest, the more you're going to use it, the higher your demand for money, because the price of money is coming down. The higher the charge on your credit card, the more careful you're going to be in terms of using it. So the higher the interest rate, the less money you demand, because it's more expensive for you on credit. The cheaper it is, and that's it from your credit card. Think about it in terms of now from a corporate side. The cheaper it is to borrow money, the more money a corporate's going to borrow. So that's why I've got a downward sloping curve. Now, just like we've got a intersection on your aggregates, you've got an intersection on your money supply, money demand. This we call, by the way, this is called R star. R star. If you ever hear on Bloomberg, they're talking about, well, where is R star? They're asking, where is the equilibrium for money supply and money demand? Where is R star? Okay, but the idea here is there's going to be quantitative tightening. What is quantitative tightening? Quantitative tightening is taking money out of the system. So we don't even have to actively be hiking interest rates. Okay. There just has to be quantitative tightening to move your money supply to the left. Where is the intersection? It's much higher. Okay. So yeah, there could be some sort of short-term signal here that maybe the Fed, it might not be as aggressive, which, by the way, they probably can't be as aggressive as they want to, because as we saw yesterday, it's going to absolutely devastate in my opinion, it's going to devastate the employment market. So and that's just stagflation, right? There's no policy prescription, right? So, but we should, you know, the supply and demand function is not going to stop because they're going to be less aggressive. It's going to continue. This is just, to me, a potential correction. Now, if this is a potential correction, okay, that means it's a potential, and that after taking 40 minutes, we now come to the crux of it. Well, this could be an exploitable dip. It could be a dip in an uptrend. Go back to the US dollar. Go back to the US dollar. This could be the dip in an uptrend. There's no doubt we've got an uptrend here, okay? There's also a normalization of an overcooked position here, right? That means this now becomes something that is worth keeping an eye on because it is exploitable. Now, if the US dollar is having a dip in the uptrend, well, that's where, say, the euro now becomes very, very interesting, because the euro has been strong. Well, is this a rally in the downtrend? Is this exploitable? Okay, what about the pound? Okay, is this rally here exploitable? And I would suggest that if this is a dip in an uptrend for the US dollar, then these are likely rallies in downtrends. Okay, now if that is the case, take a look at gold. Okay, clearly lower peak, lower trough. Okay, is this a rally in the downtrend? LP question mark, we don't know. Okay, go down to, yesterday I looked at the gold 4-hour chart. Take a look at this. Again, I put the measured moving just because it was an article. I wouldn't put too much importance on it. What I would suggest is that there has been a breakout from it's looking like a flag pattern. Okay, in other words, break down, pull back. Is this what's going to happen here? Well, that would happen if there's going to be a bid for the dollar. Okay, so that's just something to keep an eye on. Okay, so Rob, so what we're saying here is, okay, just be careful because it's a breakdown from a flag breakdown. So just keep an eye. So Rob says he's long gold. Okay, so then we wanted to move that way. Okay, so just keep an eye on that. And then let's take a look now at DAX. Okay, we'll end off here with the DAX because we haven't looked at that for a while. Let's go through to DAX. All right, let's go through to the weekly. So what we said last time we looked at it is that we do have a potential higher trough in here, but we've got this strong overhead resistance. We want to just keep an eye on that. If we break through that overhead resistance, then we get that higher peak. That would really be helpful if we can get the stochastic to show to get some nice momentum. Would help us get that higher trough. You can see that we are having a blue candle for the week, which is what the Cnbc article suggested. Let's just go down to the daily here. Daily is moving to the zone 1, so we can start keeping an eye on that. if this is a bullish move, the next part to this technically would be an expansion in the Bollinger. So if the Bollinger start pulling away from one another, and if we get candles staying in zone 1, that would be a bullish development. And then if we just go down to our hourly chart here, what you can do is just keep an eye on the hourly stochastic. Clearly, in order for DAX to end the week up, it has to have a positive momentum. If it drops below 80, then there's danger that momentum may be waning. Okay, cool. Nice, Rob. All right. Any questions? Any questions, guys? I hope that I hope today's wasn't too circular. I hope, because it was I think covered some really important stuff. All right. Enjoy your weekend as well. Have a good day ahead, and then we will catch up on Monday morning. Don't forget, next week is non-farm payrolls. I have put the link in the chat. So we're not going to be sending out an email on that. So please, if you're interested, go ahead and click on that and register. Thank you very much, guys, and speak to you on Monday.